Hello, morning everybody. Well, afternoon now. It is 12:30. Thank you very much for making yourself available in the middle of your day. I'm used to doing a lot of these at the end of the day, the graveyard slot as they call it. But hopefully this will be a good use of your lunch hour if you're having lunch now. I'm assuming everyone can hear me. Can't see any messages that say otherwise. We will get started promptly because I can see we've got over 120 attendees, but we did have a whopping 350 registrations. So let's see what happens with that. Sean, is the video working good? Yeah, it's working fine. As attendees join, they will be automatically join the meeting, so there shouldn't be any waiting around in the lobby. But we'll just wait for another minute, then we'll get going. We're doing well. It's only just gone 1:30, 12:30. We're going to make a start at any moment now. Right, so we've still got a lot of attendees jumping in, but I think we've got more than enough participants to get started. So thank you very much again for logging in time and allowing us to get off the blocks quickly. Afternoon for those people who just joined. Thanks for making the time, and apologies to people who have seen this or a variation of this presentation before. I did deliver something very similar at Accountex last year. We had a stand there, and I was in the tax theatre delivering a very, very similar presentation. And we do get around London and beyond to the ICW London societies to do these types of presentations and for other smaller groups. But hopefully you find it of interest. I always keep the name very, very similar. I'm very, very focused. We don't do compliance work here, pure tax. We focus on HMRC Tax Investigations, business inquiries, and disclosures. So that's why the webinar is aptly named as such. And I like saying, well, I'll tell you the what, the how, and why when it comes to HMRC. Where do they get the information from, and how they operate differently in different teams? It is practical advice. So it's a very long title to today's webinar, but I think it makes sense. I'm Amit Puri. I'm the Managing Director of Pure Tax Investigations. And thank you very much for joining today. So let's look at what it is that we're going to cover today. Looks like it's a lot there, and to be honest, there is quite a bit. I have had emails from people asking us to cover specific topics, but as is the case with these types of things, there's only so much time. I could easily talk for an hour or 2 hours on these issues and go on and on, but realistically, I would like people to have the opportunity to do some Q&A at the end, and anything that rumbles on, perhaps we could take that offline and carry on after the webinar. So I'm going to start by talking about myself very, very quickly, and in where I've been, the context behind doing this type of work, and also the team itself. I always like to talk about where HMRC gets its information from, and then to talk about the customer compliance group, as it's called nowadays, the HMRC's frontline structure, the place where you're going to get letters from HMRC in the main, I would suggest, and then cover how they operate differently to each other in terms of how they do their risk assessments, how they carry out their inquiries, and then the focus shifts to offshore tax, as HMRC likes to call it in the media, to you and I, the automatic exchange of information, and the CRS, the stuff that sort of leads to the WDF type of nudge letters that we see, HMRC's offshore campaigns. I'm going to cover offshore penalties, specifically the failure to correct penalties, because that's the world that we live in now. I do have examples of how these interact in real life. I'm not going to cover them in today's session because we won't have time, but I will leave those examples in this slides deck. So when this goes out, and it will go out next week, you'll have these slides. There might be something there of interest to someone. I'm going to cover very quickly property portfolio planning implementation issues because it comes up a lot nowadays. Not going to spend too much time on it, but I will flag it as an issue and leave you with something to think about. Again, I'm not going to cover non-DOMs anymore because it's kind of old news now. Really, everything shifts to what a concession or what work that we could do today looks like, and that's called the temporary repatriation facility. So I'll cover that and cover a little bit of the treaty planning, and like I said, we'll do a bit of Q&A. Okay, so a bit about myself. Again, I'm sorry for people that have heard this before or seen this type of presentation before, but I've got to go through it to do myself and the team justice. Why do we do this type of work? So it's because I started in inland revenue all the way in 2004, as it was known then, and spent 3 years in what used to be called local compliance in those days, doing self-assessment inquiries. So inquiries into individuals, into partnerships, into smaller companies. This, of course, now is known as the Wealthy and Mid-size Business Compliance Unit. The names have all changed. I then was promoted, if you will, to what was then called Specialist Investigations or Specialist Civil Investigations, because I had an eye for detail. I was described as someone who's making trouble for taxpayers' businesses because I'm a detailed person. So I went off to SCI, as it was in those days, to start to do Code of Practice 8 and Code of Practice 9 investigations, because they are quite a lot more in-depth and intrusive. You do far fewer of them, but the idea is to be all over the taxpayer and people and businesses attached to them. I then spent the next 8-9 years there in SCI, which is now known as Fraud Investigation Service, or FIS, doing that type of work. But I suppose I'm better known in the private sector on this side of the fence for my role as the offshore disclosures team leader in London, because when the Liechtenstein disclosure facility rolled out in 2009, I headed that unit for 2.5 years, 3 years, and then had a policy role looking at offshore disclosure work. So that's pretty much my life at HMRC towards the end. I then moved to Grant Thornton in London and became the head of tax investigations and risks there, before moving off to a smaller boutique in London and starting up Pure Tax, which is my business now. But again, we do tax investigation work and not compliance work. So a bit more about the team, I suppose. We're a mixed bunch. We've got ACCA qualified people here, ATT, ACA, STEP, ADIT. The idea is to continue to do the 4i style work, making sure that everybody gets to see everything that goes out by way of email correspondence, make sure we're doing things robustly. So we do bring a real mixture of experience together here. And of course, I'm an ex-inspector, hence why we do pure tax investigations work and disclosure work. If it's not tax work with HMRC, it's more penalty focused. Sometimes our engagements are entirely penalty focused, because it's worth arguing about where you land on the scale at maybe a 20 or 30% penalty versus a 70% one, whether you could suspend a careless penalty, for example. But we also get involved in looking at whether someone's details will be published. So the non-financial risk, as you will, which is the publishing details of deliberate defaulters. And then closely followed by working on some anti-money laundering compliance checks that HMRC carry out. So not other ones, we wouldn't get involved if it was the SRA doing something or the FCA, but where HMRC is a supervisor, we would normally handle those because their approach is very, very similar in those cases. I think it's useful for people to know that a good 70-80% of our work comes from bookkeepers and accountants and other tax advisors, for obvious reasons. I think if your clients pick up a letter from if their clients come running in with a brown envelope and say, I've got an inquiry or there's some interest from HMRC, they normally would go to their accounting advisor, and so they should. And if something warrants a referral to someone like us at the beginning or later on in that inquiry's life, then that's what happens. Of course, most of these inquiries, we'd only give advice to the advisors on a rolling basis so that they can deal with these things themselves. Most inquiries are dealt with in a few rounds of correspondence because that information exists and the advisors already have it. They don't need someone like us to get involved there. We do write regularly for the Taxation Magazine, Accountancy Age, Tax Insider. We've got one just finishing up an article for Accounting Web next week and another one for taxation. I think last bullet point here is very important for us, certainly. Our work is non-recurring. We're not here to poach people's clients, right? Once our work on a disclosure or an investigation is finished, we're no longer really normally involved with the clients, but the entire time we're here to preserve that relationship for the referring advisor who continues to do that tax compliance work. We do what's bread and butter for us, and we leave the bread and butter compliance work to the referrer. We're not accountants in the main. We're not operating as accountants, but we know HMRC. Right. I'm not going to go into detail on this slide because I think people know what's happening. The market's changing very, very quick. There's fewer and fewer tax avoidance schemes or arrangements that are sold in bulk as DOTAS and POTAS has kicked in. But HMRC's rhetoric has always been the same. Every year or every fiscal event, they will say, well, we put more money into HMRC, we put more money into the public sector, we're recruiting more inspectors. It's all the same message, but that's against the backdrop of the number of people that are retiring or allowed to leave early, because the numbers are going down. Even though HMRC is about 66,000 people at the moment, the numbers continue to go down. Right, so where does HMRC get this information from? It's always been the same, although there are newer sources of information added from time to time. Ad hoc information, they've always had that. It could be your neighbour, could be your business partner, could be your spouse or ex-spouse that sends in information to HMRC. It could be regular intelligence from the banks, it could be regular intel from councils or other agencies. It could be bulk data that HMRC buys. I'll cover some of that in a little while. And quite frankly, you get spin-offs from cases that are running and then they go to other parts of HMRC to be picked up. And that, that's the normal stuff. All of this stuff goes into Connect, but almost everything that HMRC goes into Connect. I'm sure you've heard of it. Another tax advisor or tax investigations advisor certainly probably would have flagged Connect. It gets talked about a lot. In my time when I was at HMRC, it used to be called ICE before it was rebranded in 2008, 2009. But nearly £50 million was spent on its industrialization phase and getting all these databases in there. There's more than 30 streams of information. This is published. I think it's well in excess of 30, but last time HMRC confirmed it, they said there's more than 30 databases that are in Connect. There's over 55 billion lines of data in Connect as well. So, it is scary. And as one of the bottom bullet points say here, there's more information here than the British Library. British Library has pretty much got everything you can possibly think of. I read somewhere very recently, this is a new stat, that another 200 plus million was spent in the last few years improving Connect. These are whopping big figures, but when HMRC tell you what they'd like to tell you about Connect, but this is what you see. So last time HMRC commented on Connect publicly, they said that it had helped them secure an additional £3 billion from compliance activities. So that's a huge number, £3 billion, but how they measure it, of course, we don't know. But another interesting stat, Connect is used or available, certainly they're convinced that it's used in more than 95% of all of HMRC's compliance cases. So that's up and down HMRC. But what does it look like? I can give you an example, right? It says here spider diagram illustration because that's exactly what it looks like. If I was an inspector or an analyst at HMRC and I put in, right, I want to see whatever I can at my fingertips about Amit Puri. So they put my name in, they might put in part of my address and or my date of birth to really home in on the right Amit Puri. And within a few seconds, you would see a huge spider diagram. It was often so big that you'd have to physically go and remove chunks of it so you can actually zoom in and see the bits that you wanted to get a view of, because it's quite big. It latches onto a spouse, it latches onto fellow directors or partners in a partnership, for example, shows you what properties have been bought, shows you what conveyancer was used, what stamp duty was paid, telephone numbers, sometimes DVLA data, and the list goes on, as the next screen will show you. But of course, HMRC buy data, offshore banking data. For example, people might remember the leaks in the HSBC from Jersey, remember Panama Papers, Paradise Papers, the list goes on. Pandora Papers. All this makes its way to Connect as well. Not to say it's only offshore data. Of course, domestic data is going in all the time. HMRC are buying information from places, but it gets an awful lot of information automatically. And the next slide will give you an idea of some of this stuff, right? So, here's just a glimpse of what it's got. UK banks have been given information to HMRC for an awful long time, but I would be clear and say, actually, it's not very good. It gives you the name of the person. It normally just gives you the interest and on that account. And if you're talking about ISAs or some of the older among us, TESAs and PEPs, for example, not only do you get annual income figures, but you'll get balances and capital introduced figures. But the overseas information is a lot richer. As we move on later on to the overseas part, you'll understand what is coming into the UK and obviously going on to Connect as well. It's very detailed. Mortgage, loan fraud information from lenders has been coming into HMRC for years. As I said, the DVLA, working pensions, credits related information, but importantly, land registry information. It's available to HMRC very quickly. If you don't see it on Connect, you can do a request, maybe nuanced around the address so you can work out who bought it, who sold it, or nuance around the person to see what they own or what they've sold. Stamp duty office information is there as well. Often leads you to the conveyancer involved. And I know in some of my investigations when I was at HMRC, we often went to the conveyancers to see their papers or their files, to see who was instructing them, where they were instructing them from, for example. So it's very rich. Council tax information, voter roll information is very important, especially in residence and domicile inquiries. Payments to private landlords have been going to HMRC for years. Right? I don't think HMRC do a very good job of looking at this, because where councils have paid landlords, I'm surprised that there's not a lot more inquiries or projects around this, but maybe they have been in recent years, but they just haven't admitted to it. Experian they've had at their fingertips for years, so your store cards, your credit cards, your mortgages will all be there. Any defaults on there will be there as well, which is useful for them to see what the outgoings might be, and when they're comparing them against known incomings from tax returns or P60s, for example. PayPal's a more recent addition here. As you'd expect, Companies House information is there, as it is publicly. But more interestingly, online marketplaces. A lot of talk about eBay's and your Amazons, Airbnb, Booking.com. The list goes on. Zoopla, Rightmove, Gumtree. They're all sharing information. Etsy always gets a special announcement, but I suspect they were part of a pilot or a pilot project at the beginning, which is why they've been publicized for such a long time. If people didn't know already, they should do that. Merchant acquirers is something that HMRC have had since before I left in 2015. That is a businesses, they'll have a credit card machine, debit card machine, for example. Those records are available to HMRC, and they do run projects and task forces off the back of that. Social networking, I know HMRC have had access to this because when I had a policy role at HMRC, the policy teams used to see whether something positive or negative, what the sentiment was around new policy measures or something announced at a fiscal event. I don't know enough about project work off the back of Facebook or Twitter and Instagram, but I know where people have open profiles, inspectors will use that information if they've gone to look at that and use that in a business inquiry anyway. We've seen that happen. But what bulk action is taking place, I don't think there has been anything about that, but there's certainly not been anything advertised in that space. So that just gives you an idea. Like I said, a lot of information. UAE property register has been in there a good few times, which led to projects as well. People will know that Coinbase was an example of a crypto platform that had to share all of its information as part of a pilot. That information now regularly goes in there, but Coinbase is not the only one. There are many, and by 2027, all UK platforms will all be sharing that information with HMRC. Right, let's move on to the front line. I think this is very important because, as I said, HMRC on last check towards the end of 2023. There were circa 66,000 people across HMRC. It's still a very big place. And when I joined in 2004, the customs and excise and inland revenue together were about 110, 120,000. So it's halved over that time. But a good chunk of that, so some 26,000 is what the number I've got here. 27,000 of them are in the front line of HMRC, so known as the customer compliance group. I've got another slide on this so you can see this visually in a moment. I'll come back to this. But the customer compliance group is essentially where your clients or yourself are most likely to see a HMRC letter from. Talking about maybe a nudge letter where it's not a proper inquiry, but there's some sort of prompt here to seek advice, or it's a personal tax inquiry under Section 9A, or a corporate inquiry under Schedule Paragraph 24, whatever it might be. Those letters tend to come from the Individuals and Small Business Compliance Unit, or the Wealthy Mid-Size Compliance Unit. The two middle ones, they make up the vast majority of the front line up and down the country. These, as you can see here, Fraud Investigation Service bring together the old civil and the old criminal investigation units at HMRC. RIS they shouldn't be operational, but they are. So the risk and intelligence service part of HMRC, their job is really to go out and procure intel and procure data, produce projects for operation teams up and down HMRC, not really carry them out themselves. But if you've ever noticed where a Let Property campaign nudge letters come from, or a WDF letters come from, or some other campaign or task force, it is normally RIS that runs those. And if they need to flag a case or escalate a case, then it might end up somewhere else. But their campaigns are normally within RIS. I've deliberately left counter avoidance here on the side, on the left in blue, and large business directorate in blue on the other side, because they are new. They're new entrants into the main front line, if you will. Once upon a time, they were completely separate and sat outside of the old enforcement compliance, but now they've brought them all together. I'm going to go back a slide, because this is quite important. So Fraud Investigation Service is actually made up of the old Specialist Investigations Unit, which is basically civil investigations of fraud, or civil investigations where there were large amounts of tax at stake. That is essentially Code of Practice 9 and Code of Practice 8. The criminal investigations team used to be completely separate, but they brought them together in around 2015, 2016. The vast majority, as I said, of HMRC, the compliance side anyway, sits in individuals and small business compliance, and also the wealthy mid-sized business compliance unit. All of this was once upon a time part of local compliance. Now, the next section in blue, these units don't exist anymore, but in my time in HMRC, they had their own identity, the specialist personal tax units and the personal tax international units. So this all been absorbed into the mainline WMBC now of HMRC, but really the trust and estates units, which used to look at trusts and settlements, IHT, deficit states, or IHT for trusts, all of that has been absorbed. Residence cases, or resident specialists, should I say, non-dom specialists, remittance-based specialists, anti-avoidance rules like the transfer of assets, settlements legislation, all of these specialist areas, they had their own identity. I suspect those specialists are still there, but much smaller now, but they just sit in various teams, and other parts of HMRC will use them as and when they need to. I'm not going to spend too much time on this slide. I'm going to move forward, because I think I covered most of it when we were looking at the other one. But just to reiterate, RIS is not supposed to be operational, but it tends to run, certainly operate or start campaigns and task force. So you will see correspondence from them, especially in the Let Property campaign and WDF world. I'm not going to cover what type of individuals sit in the wealthy part of HMRC, or affluent or high net worth unit. I can cover that another time. But importantly, the large business directorate is really dealing with businesses with a turnover of more than 200 million. It's a very, very different approach in that part of the world. But how do they operate, right? I would suggest that I believe that most of us are unlikely to be involved in cases where large business directorate is operating. This will be the home to your Amazons, your Starbucks, your Shells, your Coca-Cola, for example. It's a very, very different world here. So large business has customer relationship managers, so it's quite soft. You have a named contact, or a customer coordinator, as they're sometimes called nowadays. You will, as a business, the finance director or the entire finance team will be working quite closely with the CRM and the customer coordinator, because they're not really under a inquiry periodically. You are constantly, as a business, effectively under inquiry, because you have so many different moving parts within the business in terms of locations, in terms of tax planning. So those things are under discussion all the time. So HMRC are risk assessing all the time. Their portfolio of large multinationals, for example, their teams are built up of analysts, experts, so VAT experts, employment experts, duties experts, for example, specialist accountants, and sector specialists. So you might have an oil and gas specialist, you'll have a hospitality specialist, for example, or whatever it might be. Really, the point to take here is that HMRC, when they are operating in this space, they'd like to have a team-on-team approach. So not only will the customer relationship manager go and meet along with normally 5-6 of their HMRC experts for different taxes, they'd expect the same from the client. You know, it's normally several people from the finance team involved in that, because these are real-time conversations. If you contrast that with the wealthy mid-size unit, for example, especially the mid-size business part, remember they are very, very big businesses in this part of in this area of HMRC, effectively, if you want to call it that. So businesses that aren't quite at the £200 million turnover mark, but still the huge businesses, not the small end. They are not under inquiry all the time, so they will get a paragraph 24. They will get an inquiry from time to time based on risks, just like the individuals or high net worth unit and everybody else in wealthy, and just like the non-high net worth taxpayers that fall into the individuals and small business part of HMRC. So inspectors here will risk assess cases. They make decisions as to whether they're going to continue with those. Almost all of those cases come from risk, so they are pre-risked. But normally inspectors have the final say as to whether they run with them or not. You know, I've put in here clear blue water. This is, you know, I joined in 2004, but this is already happening. I was told that there was a time where, maybe perhaps before self-assessment, there was, you know, there was a misconception, or maybe it wasn't a misconception, there was a tendency for parts of HMRC or in their revenue in those days to focus on cash businesses. For example, I'm just picking on cash businesses here. Let's say Chinese restaurants, Indian restaurants, cab drivers or labourers, for example. And it was easy to self-generate those cases because where there was, and it was quite frequently, a lack of business records, and you're looking at the means position, it was rich pickings, right? So the HMRC were accused of not having clear blue water between the parts of HMRC that were using a risk-based approach to selecting cases and those that are actually carrying these cases out. So that's one of the reasons why RIS has grown to what it has today, because it's to demonstrate that actually we have got a robust approach. We're looking at the risks wherever there might be geographically or in a sector. We're not just going for easy wins. But the point I would make to you here is, you know, don't believe the opening sentences you see on a section 9A or a paragraph 24 notice of inquiry, right? As in where HMRC say we do lots of inquiries every year. And so we're seeking the following information. These are not random cases. You know, HMRC do not randomly pick a few and then ask lots of people to go and open those cases. That's not how it works. They are always risked by RIS or more locally within a certain unit, and then they are often then rejected, and some are run. They're not random. You know, there's a method to the madness there. These criminal units, obviously, they're responsible for prosecution cases. But there's a range of other cases that they're involved in. But the point being that it's a view to prosecution and maybe later on a confiscation order. They spend a lot of time risk assessing those cases. They do tread lightly, maybe like large business, but it's not a nicey approach in FIS, because when you come across a FIS criminal investigation, it's going to likely be that one of your clients or someone you've heard of has been arrested in the morning because it's an arrest warrant along with a search warrant, if not just a search one. The few and far between here, because the cost of the resources and the sheer manpower is enormous. And often other agencies involved here, you know, you're not going to get HMRC knocking at the door in the morning on their own. They're going to be with the NCA and or with the police, especially if someone's going to be taken away for questioning at the police station. So you see far fewer of those that spend a lot longer preparing for those cases. So coming back to FIS civil cases, which is more of what we see here, so Code of Practice 8, Code of Practice 9 cases, again, a lot more work is done in the risk assessment stage or the pre-registration case compared to the WMBC and the ISBC, because there are fewer of them. You know, these FIS offices, there are probably only 10 or 12 of these up and down the country nowadays. They're as small as 20, 30 people sometimes in these parts, where you're talking about thousands in the others. A FIS investigator might only have 8 cases, 10, you know, at tops, I would say maybe 12. but they are often looking at the individual or individuals. So there might be directors of a company along with that company or other businesses associated. So all of those together would be one case in that part of the world ahead of a COP9, fraud allegation effectively. Whereas in WMBC and ISBC, you've typically got 30, 40 cases on the go at any one time, because most of those cases in a few rounds of correspondence will be closed for nothing. There's often no adjustments. HMRC are looking for underlying, what could be an example? They might be looking for a breakdown of entertainment, marketing, to see whether that was actually entertainment should be disallowed. They might be looking at debtors to find where director loan accounts should have been in other debtors or clearly on the accounts. But the point being that they often target certain parts of a tax return or a accounts, and as advisors, you probably have that information, but it just didn't need to make its way in that much detail on a return. So those risks are normally fairly easily dealt with by HMRC, and they call those A settlements because they move on quite quickly. But every now and then they latch onto something that is not right, and they'll get an adjustment from them. I think that's far more unlikely in a code of practice 8 or 9. Some do close for nothing because HMRC have got something completely wrong because they just don't have that information, and it can be put to bed. But my old analogy is the HMRC like to shake boxes and they carry on going. If you antagonize them because you think you're protecting your client or blocking the information where actually you should have sent that information because they're just, their business records, they should be shared. There'll often be an adjustment. I don't see really COP 8, COP 9 cases closing for nothing. And I've put down self-generated here because HMRC do in this part of the world create a COP 8, COP 9 themselves. Depends what people have been saying in their papers. It depends what intel HMRC have got from other sources. It might be a spin-off from the Serious Fraud Office, might be something that's come from the NCA. It could have many different parts of HMRC it could come from. But we're now going to move on from a domestic focus and look at more the offshore. This is sort of, I appreciate we're coming to 1 o'clock, so this will change the tone a little bit, I suppose. So the focus is now offshore tax. We're going to have a quick quiz, but I'm not sure how we're going to run this quiz actually, because unfortunately, despite having 2 screens here today, I can't see the answers people might come up with. So we'll assume that you've got the answer in your head, but I'm going to give you the answer, and so you can check for yourself. So in terms of offshore tax, what's HMRC's problem with it? Most people say they might be bored of reading about offshore tax evasion or what's described as offshore tax evasion in the media. But HMRC's problem with it has always been that secret or private jurisdictions, private countries or territories, as many names, they do cause and they do encourage a couple of problems for any tax authority, not just HMRC in the UK. It's because often you have money that is easily concealed in overseas accounts because that information is not shared readily, even on request under double taxation agreements. And sometimes it's more complicated because there are corporates and or trusts above those accounts. And again, sometimes the purpose of them is just to conceal the identity of the people that have those monies for no other good reason. Of course, there's many reasons of having monies overseas and accounts overseas, as well as companies and trusts. But we're talking about the redder end of the market here, where people are hiding funds and possibly business income overseas. So that's their problem. So that's why HMRC been on this crusade for a long time, for probably about 15 years plus now. Certainly since around 2008, 2009, when the first disclosure facility went live. So if I give you this example, the first question here, the BVI, and I check this regularly, its population is just over 31,000. It hasn't really changed. It's been about 31,000 for as long as 10, 15 years I've been looking at it. But even last week I checked, it's about 31,500. How many offshore companies do we think are registered here? How many companies are registered in the BVI? Active companies I'm talking about. And you've got to ask yourself, why is it? If there's only 30,000, how many of them are entrepreneurs? How many of those need companies? So do we think it's about 10,000? A third of the people on the island? Do we think it's 100,000? Do we think it's more? 500,000? As I said, I can't collect this information. If I was wandering around in an auditorium now, I'd have more fun with this. But people shouldn't be surprised to know that about 10 years ago, HMRC used to say it was 500,000. So it was about 500,000 companies that were registered there. It's steadily reduced over time. I've been tracking it. It was 375,000 a few years ago, and as of about a year ago, it's now 366,000. That's an awful lot, right? And it's not to say that the 31,000 people on the island have got all these companies, because it's there have been various studies. The BVI is known as to house nearly half of all the offshore companies around the world for other jurisdictions. It used to be about 45%. I've got a paper on this. And when I checked recently this week, it was now 40%. That's an awful lot. Double taxation agreements. They have many reasons for this. What they actually do is automated information exchange, or provide for the exchange of information on requests. And there are other protocols here to relieve double taxation relief as well. But how many do we think HMRC or the UK have? This is a really interesting question, because some countries don't have many at all, and some are now catching up. But do you think HMRC, the UK, should I say, have got about 50 around with other jurisdictions? A bit more, 75, or a bit more, 100? What do we think? I get people saying that there was maybe 500 or more, but I disagree with that. I don't think there's 500 jurisdictions out there. But actually, the answer has been for a while, in terms of what you'll find publicly. The UK has more than 130 agreements with other jurisdictions, DTAs, which is an awful lot. It's one of the largest networks of the double taxation agreements around the world, and there are over 3,000 around the world. But the UK is one of the leaders in that space. And while some people don't know what a tax information exchange agreement, or TIA, is, but it's where you don't have full double taxation treaties with other jurisdictions, but at least these are more easily agreed with jurisdictions that just really provide for the exchange of information, and not really looking at double taxation relief. So again, this used to be about 20 plus, but I only learned a few weeks ago that the UK is now at about 40. Again, probably one of the more advanced compared to other parts of the UK. I'm going to skip the next question, because I don't expect most people to know the answer to this, and certainly HMRC haven't published new information in this space. But as part of their crusade against offshore tax and bringing in money where people had accounts or structures around the world, the number sits at around about £4.5 billion. That's how much HMRC have got now from Swiss agreements, Liechtenstein agreements, or agreements with the overseas territories, and wherever these disclosures, like the Liechtenstein disclosure and WDF, are now taken them. So it sits around, last published, about 4.5 billion. It's nowhere near where they thought they would be in terms of what they published. But realistically, there's never been an MP or a Treasury Minister who hasn't patted themselves on the back to say, and quite rightly, I would say, they said, if we didn't have these agreements, if we didn't do what we did with Liechtenstein and Switzerland and these information agreements, we wouldn't have got this extra revenue. So, they've had to get out of bed to get this. And the last one, I'll cover this in another slide as well. How many agreements do you think HMRC have with other jurisdictions where now banking information, financial information about UK residents? So how many of these agreements do we have? Every year, this information is coming to HMRC. Many people out there don't believe there's very, very many. If I ask people why they thought it was so low, they typically believe that only the EU was sharing information with each other. Of course, we're not part of the EU anymore, but I will tell you that, having checked in the last week or so, the UK now has there are 126 countries that are automatically sharing this banking information with each other. This is as of the middle of March, 13th of March. So this is information that each country doesn't need to request from the other jurisdiction, doesn't rely on the double taxation agreement or the TIA. This is information that comes in by the summer every year with reference to the previous calendar year. And it's quite rich, as I will show you on the next slide. If the common reporting standard has missed you, I would wonder where you've been over the last few years, because it's somewhat of a revolution around the world. If we focus on the UK, the UK can expect information for more than 120 countries every year. So if a UK resident and a bank in Switzerland, a bank in the UAE, a bank in India, a bank in wherever it might be, if there's one of the 120 plus countries, they will share that information automatically. And as I said earlier on, this is richer than the domestic information that UK banks share. right? It's not confined just to the interest income. It's also things like dividend income. It's also things like the sale of financial assets. And importantly, it's a bank balances and the values of portfolio accounts as well. Now, this is really important. Don't confuse this with FATCA, for example. FATCA has de minimis limits for individuals, but there is none for the CRS. If people were quick to empty their accounts out and didn't stick around to close those accounts, those nil balance accounts are being reported to the UK as well still, right? To give you an example, it's very, very rich information. To give you an idea, all of the EU have been sharing information since 2017. The early adopters. Countries like India were an early adopter as well. They've been sharing this information an awful long time now. So every year, for example, your Switzerland's, your UAE, Singapore, people have often interest in them. Monaco, they started the year after 2018, but it's been building up literally between 2017 and 19. You had almost 100 countries that were sharing information with each other, so it's moving at an alarming pace. If anyone wants the link to the up-to-date list of these countries and when they started sharing, just drop me an email. I'll share that link with them. It changes all the time. What is this information? It's intel. HMRC use it in lots of different ways. If they look at this intel and there's already an inquiry open, you can expect them to use it. If there aren't any inquiries open, but they'd rather hundreds of letters be sent out, thousands of letters be sent out, and to encourage someone to do disclosure, that's what you find. Certainly, if anyone's familiar with a WDF or a Worldwide Disclosure Facility nudge letter, that is what you're looking at here. That information largely comes from the CRS data. The HMRC will ensure that there isn't something more serious like a COP8, COP9 open. And if there isn't, the chances are that when they do their sort of 10, 20,000 letters, which they do a few times a year, this is where the data is coming from, and it's designed for that recipient to run to their advisor or their regular advisor to perhaps send them to a specialist tax advisor who can do these disclosures. In the case of India, it's not simple as taxing everything. It's not as simple as claiming relief at 15% for everything. Most of these accounts, there is no tax paid in that jurisdiction, like India, for example, but you can still claim a measure of relief in the UK. There are ways of doing that. You could end up with a careless penalty, which is most likely, but it still can be suspended. So there's lots of different things you can do in this space, but the penalties I'll cover in a moment. I'm not going to go over this slide, but when you get this, if you're inclined to look at this and reminisce, let's say, you'll see how the offshore market or the offshore focus at HMRC has changed over time. There have been lots of disclosure facilities. As I said, the LDF was my realm. I was the head of the LDF in London for 3 years when I was at HMRC. But now we've got the WDF. There's no closure in sight. It's ongoing for the foreseeable. This slide, I'm not going to cover the requirement to correct, because that is when the the WDF disclosure regime started. And the idea was that actually people disclose and fix everything, historic issues within that small window. I think it was a year and a half, 2 years. If you did that, the normal offshore penalties applied before the failure to correct penalties applied, right? That was really the only carrot that was given them. But we moved, and the world has changed. We're in 2025 now. The failure to correct penalties have been in place since 16-17, the tax year 16-17. They apply to all prior tax years. So if they're in scope now and someone gets a nudge letter and you're looking at 15-16, 14-13, those years, you will get a failure to correct penalty. The new penalty starts at 200% of the tax. That's the starting position. The most you can expect to reduce that to is 100%. That's the absolute minimum in that penalty. If people get that letter from HMRC, nudge letter, or you're being flagged or prompted in the middle of an inquiry, you can't end up with a 100% penalty. The minimum it could be is 150%. So, it's important to know these things. It's got nothing to do with behaviour. HMRC don't need to find out someone has deliberately caused an inaccuracy or deliberately withheld information. This failure to correct penalty applies because there hasn't been a disclosure, or pre-15-16 periods haven't been regularized. And furthermore, where HMRC need to normally find that someone has had a deliberate penalty in a case, to publish their details online, where there's been at least £25,000 additional revenue, they don't need to do that where there's been a failure to correct penalty. Because if there's been one, and someone hasn't deliberately caused the issue, their name can still be published. As simple as that. If you get a failure to correct penalty, you can be published. Interestingly, there was a new penalty that's been around now for almost 10 years, which was designed to be based on the asset value in those cases. I've never seen one in practice, interestingly, so it's more of a deterrent than it is, I would say, something that's in use. And as was the extra 4 years that HMRC had to make assessments. Anything that was assessable in April 17, automatically HMRC had another 4 years. This was around the time when the WTF kicked off. So this is not as important anymore because we're in a different era. But I will pick up on some of the other penalties, which is very important for people to understand. Right, again, in the offshore arena, the regular, oh, I've made a mistake in my tax returns, right? But I took advice and, I took advice and I followed it and it's been implemented, but I've taken reasonable care, shall we say. HMRC typically only have 4 years in those scenarios with no penalties, but not when it comes to offshore tax cases. They can go back up to 12 years, even in those cases. Where someone's been careless, typically HMRC have 6 years in a domestic case, and they can go for a small penalty of between 15 and 30%. Again, HMRC can go up to 12 years in assessment mode where offshore cases are concerned. It's very important. We keep finding people that miss this, unfortunately, but they need to be aware of this. In offshore cases, very different. The offshore penalty regime started by looking at offshore matters. So typically income and gains that used to arise overseas and a few other scenarios. But don't forget, it changed. It was only like that from 2012 for about 3-4 years. Then the offshore transfer rules kicked in, which is a bit different. So you might have a business that is very much a UK business, but some of that money, most of that money, whatever, it might have been diverted to another location, or it might have landed there temporarily and then it was moved to the UK. Whilst that is a UK business or a UK focus, and historically a domestic looking issue, not anymore. Because that money has made its way somewhere else, or at least landed there temporarily, the offshore transfer rules catch that, and the offshore penalties are in play again. Again, I'm not going to cover all these bullets because people can read those and get a sense for these themselves. These were some of the examples I talked about earlier on in terms of the FTC penalty in practice, but I'll leave that for people when they look at the slides because I'm conscious of time. Property portfolios. I've been asked a lot about this, so I'm going to spend just a minute or two talking about this. Again, I'd be very surprised if anyone's missed what's been happening in this space. A tax commentator, Dan Needle, has been very vocal in this space. Certainly in 2023, he highlighted less tax for landlords and their planning in relation to hybrid partnerships, which then led HMRC to rush out Spotlight 63 to say we don't like it. As far as we're concerned, there are lots of existing anti-avoidance rules that say that this should never been allowed. You can't introduce corporates to circumvent finance cost restrictions and basically just allocate it, all the income to the corporates. They don't like that. So that's the world that we live in. And less tax for landlords are one of the promoters of those schemes that Dan Needle focused on and HMRC's Spotlight 63 focus on. But let's not forget the property portfolios in corporations. That is rife at the moment. I'm only going to give you one example, Property 118. Anything that they've put out tends to be in this space, and there are lots of bastardized versions of this planning. We see so much where advisors have effectively copied and pasted what promoters like Property 118 put out there and suggested that was tax advice, which it isn't. But this is a problem as well because the advice seems to suggest it's very automatic and very you should expect to get incorporation relief for CGT purposes. You should expect to get stamp duty relief under Finance Act 2003. But actually, we're not seeing a close enough focus on buy-to-let landlords. What they're actually doing, do they have bona fide businesses that would have secured incorporation relief? Was there a partnership? And was that partnership running for long enough? Does it look like it's avoidance? Would this SDLT relief provisions apply? So we're seeing lots of problems here, and that's typically because the beneficial ownership, through a series of legal documents, was said to be transferred to companies. Nothing really ever changed at land registry or with the lenders. We're talking about a legal ownership versus beneficial ownership issue. We saw lots of these. We know lots of people have done these over time, and unfortunately, it was sold in the market as something very, very vanilla, right? And the reason why the promoters got away with this is because there just isn't, there wasn't, and certainly isn't even now, any case law to suggest otherwise. But we're heading that direction because there are so many of these cases out there at the moment. But I suppose, you know, what could you do in this space? If you ask us what we're doing a lot of voluntary disclosures for people that have got into this quite late in the day, and there are ways out of this if they haven't implemented it properly, the planning, or if it's not very old at all, or really you need to look at personal circumstances and specific cases and defend those cases on the merits of their implementation of the advice. So there's a range of things that we can do in this space. It's not all doom and gloom, but, you know, watch this space because HMRC are preparing cases for the tribunal. I was going to talk about non-domicile, not this slide anyway, but just to let people know there is planning, but certainly we're, for example, like India are one of 4 jurisdictions that have got special treaties with HMRC, so such that if someone is domiciled in that jurisdiction under general common law, there's still some IHT planning that can be done despite the rules in the UK changing drastically. So I'm not going to cover that, but you can see this slide and get an idea for how this is done and why people still are doing it. 6th of April 25 saw a lot of changes. You know, the non-dom regime is effectively gone. You know, you can't really be non-dom here for tax purposes because the remittance basis policy doesn't apply for people that have been here, that are arriving here. The new foreign income and gains regime applies. It's only beneficial for the first 4 years that they've been here, but in the same way that remittance basis unfortunately meant that you lose your personal allowances and your CGT and your exempt amount, that's the same here as well. But there are some slight differences. So you can nominate foreign income and gains. You don't have to remit them in the first 4 years. You can just nominate them and bring them across later on, or bring them across in those first few years. So that's slightly different. But then after that, it's a rising basis effectively for everybody. And I know I'm rushing through this slide because I'm conscious of time. But what I would say is that there are concessions, right? HMRC have tried to soften the blow. Tories were trying to do the same. Labour have tried to do the same as well, but not in the same way. For example, if people have assets, let's say they've held them for 10 years, 20 years, for example, but they're realizing again now, because they're on a rising basis, for example, but they previously claimed the remittance basis, they can rebase those assets to their April 17 dates and crystallize those gains now. So the gain should be much smaller. That's one of the concessions. And for everybody else, there's a temporary repatriation facility in the main. That's what we're gearing up to do more and more on. We're probably doing more of these on instructions from lawyers and bankers overseas at the moment. But I'm sure as people understand what this is, there'll be instructions in the UK more and more as well. Give you a real example. If people have been using the remittance base for a long time or forever, let's say, for example, the chances are they've got a lot of foreign income and gains that haven't been taxed here in the UK because they've been protected, but they would like to bring that income, you know, pooled gains here in the UK, and maybe gift it or invest it here, you know, or pass it down to next generation. Importantly, over the next 2 years, HMRC are only going to tax those amounts at 12%. So it's very good, much better than income tax at 40 or 45%. And again, 12% is better than capital gains at 28%. So it is useful. Then the rate goes up for a year slightly by 3%. So it's very, very beneficial. If people are looking at mixed funds where they're not really sure where the income is, where the gains are, they've just been claiming remittance basis, but never looked at it properly because it's a mixed fund. This is when we have the opportunity to go in and do a detailed analysis year on year to find out what the offshore income was, what the offshore gains were, what the old capital was, because anything that was capital can still be brought here tax-free, but anything that was gain or income overseas, that will be taxed at the 12 or 15%. So there are opportunities, and I think I'll leave it there for now because I'm conscious of time. I just want to say thank you to everyone for attending. I know we started 5 or 6 minutes after the 12:30 mark to allow people to join, but we are approaching the end of the hour. Again, thank you very much. I am going to send out the slides hopefully next week, and if the video recording is looking good, we'll get that out to people next week as well. So you don't need to wait for that. But I'm going to try and take some questions when I get this screen up. We haven't done bad. We had over 350 registrants. We've got at its peak over 150. That's pretty good. Let's have a look at the Q&A section. And I'm sorry if I can't go through many of these, because I appreciate some people haven't got more than an hour to spend. But please do get in touch with us offline. Looking through these. Looking at the Q&A section. Are there any more? I'm just talking to the team here to make sure that I'm not looking at the wrong Q&A section here. I can't see many questions here at all, or any, in fact. But to answer those questions, I think I already have. Yes, the slides in PDF format will be made available next week. They'll go out to everybody that's registered today. So I'm sorry if you don't want them. By all means, archive them or delete them as you will. You're never too sure how these recordings come out, but if they come out, well, I'm happy to, and will of course send that to. I'm going to wait for another sort of 30 seconds or a minute to see if there's a question. There is one. You might have to update it. Okay. There isn't a question here from Dhruv. Are disclosures in respect of HMRC offshore nudge letters considered a prompted disclosure? Yes, in our experience, they are. I have seen on occasion, though, where disclosure goes in and it doesn't make reference to this, or it makes the references to the disclosure being unprompted, that HMRC just haven't checked it properly and it can slide through. I'm not advocating that that's what people should do, but yes, having checked it a few times with HMRC and actually been challenged on it a few times, once a nudge letter or a prompt to use the WDF has been sent to someone, I think that person is at risk of receiving a notice of inquiry or an assessment, which is the trigger for being prompted. So I hope that answers your question, Dhruv. Right, I wasn't refreshing this as quickly as I could have before. HMRC to employ further few hundred staff for offshore tax avoidance. Yeah, HMRC, like I said earlier on, Guy, HMRC, or certainly the ministers will always say they are spending, hundreds of £1 million more at budget or at autumn statement. It's the same rhetoric that has never really changed, right? But the problem is that the number of people, or the attrition, is higher than the number of people they're recruiting. So it's a fact that there are fewer and fewer people involved. It's a fact that they over rely on IT. For example, we are seeing more and more task force and nudge letters, because that's a one-to-many approach, and they need less resource to deliver that work, rather than one-to-one inquiries, investigations, where they tend to get more out of those cases. But certainly, yeah, there are lots more people going in there, but overall the numbers are going down. Got a question here from Seb. Penalty for nudge letter. US income not previously declared on their return. What penalty rate have you seen HMRC apply? From memory, the US is a category 1. It's a slightly unusual jurisdiction. I can't remember at the top of my head, because we don't really do many disclosures where there's US income, but it's typically treated as a category 1 jurisdiction. So the penalties are not increased. It's the same as the domestic rates here. So the United States are signed up for the Common Reporting Standard, sort of, but they say they're going to share the information that they would in a reciprocal manner as per FATCA. Now, FATCA is very different. FATCA is the US version of CRS, but it's very, very one-sided. Banks around the world have to notify the US about US residents that have got counts in those jurisdictions, or they face massive penalties. There is a reciprocal arrangement there, but even when I was at HMRC, that information just wasn't very rich. And what I'm understanding now is that it's still not rich now. You don't get a lot of information back. But nonetheless, HMRC do treat US as a category 1, which is a very transparent jurisdiction and an automatic provider of information. So the penalty rates are not increased in the case of the US. Mohit Property 118, yes, absolutely, we do help people, right? But the answer is very, very different. Some people are truly well and truly caught because they would never really satisfy the Section 162 incorporation relief criteria, so they have inadvertently created a CGT charge for themselves, which is dry because they haven't sold their business to anybody. That is a problem. But for everybody else, it depends how long ago you undertook the planning, depends if you implemented it properly, whether there's a get out clause there, or it depends on other implementation issues. And actually, some people have been very, very robust. They've gone in and they've changed the ownership of the properties at land registry. They've even told their lenders, or they told their lenders quite quickly. All of these would lead to a different answer from HMRC. But as I said, I can't tell you a firm 100%, well, this does work or this doesn't work, because there is no case law on it, right? But we know HMRC are challenging everything at the moment, but our approach in all these cases is different. Raj, interest income in India disclosed in the UK. When the capital is old and income brought to the UK, what will be the tax position? Especially now that we're over the 6th of April 25, you're now into a position where, if we're talking about mixed funds, for example, the temporary repatriation facility, for example, is what you really need to do in that scenario. Because what you can't do is say, well, there's an account here, it's got £5 million in it. We're only bringing back £2 million because that was clean capital. That is what that person had when they moved to the UK first. Unfortunately, where you've got mixed funds, you always have to follow the strict rules that HMRC have. As to HMRC say, first you're going to be treated as repatriating your foreign income that hasn't been taxed here, then the foreign gains, then the foreign income, employment income. So anything that's taxable is going to be deemed to be taxed first. Then you're left with capital. But with the TRF, you've got opportunities here, Raj. I think we pick this up offline, but there are opportunities here. The capital has to be identified. OS, thanks for your question. Do we have to reply to letters which relate to SDLT checks? Not an inquiry if it is sent after 3 years control period. I'm not entirely sure about this question. I'm not an expert on SDLT. SDLT is different to direct taxes in that you're not going to get a notice of inquiry in the same way. So their window is not the same. But I am aware that they can raise something similar to an assessment, but I'm not an expert on their assessing time limits, I'm afraid. We've still got over 100 people on, so I'm going to try and answer a few more questions if I may. But obviously, feel free to leave if people need to. Do you also specialize in VAT, Mohit? Unfortunately, we're not VAT specialists, no. So if we've got a nuanced question about an education business in terms of VAT or a customs related question, we do have specialist contacts that we normally refer people to, because I think it's important to get that right. We wouldn't be the right people. But where you're talking about a business inquiry or a COP 8, COP 9, and we're looking at sales in a generic sense that have been underdeclared, let's say a retail business or a wholesale business, for example, the VAT, the suppliers concerned often follow the VAT-free accounts, if you will, right? It's easy to deal with the VAT because everything is around, do we have all the records to identify which has previously been undeclared? So the VAT in those situations we do handle, yes, of course. Haroon, let property campaign, is it useful for HMRC who started one rental property in 15-16 but has never submitted rental account? Is it useful for HMRC? If I've understood your question right, what we're talking about is someone who is perhaps immaterial compared to others because they've only had one property for, say, 9 years. They've never done rentals account. Should they do the rental property campaign? I mean, the answer really here is yes, because it wouldn't be prudent to say no. I do know people who say that we just put it into the last accounts, last tax return, and HMRC haven't asked any questions. Well, all you've really done in that scenario is ensured that that last tax return for the last tax year is correct, let's say. You haven't really regularized the past. So do HMRC have recourse to using their assessing powers for the prior 3 years or 6 years? Yeah, absolutely. So the only way to stop an assessment coming for the earlier years is to do a let property campaign. So if someone's been careless because they have been doing returns, but for whatever reasons, which I'm not going to cover now, they should have done another 5 years worth of declarations. Then the only way to fix that really is a property let campaign. It doesn't matter if it's one property or 10 or 15. That is the way you would do it, because otherwise, as time goes on, you risk the client being accused of deliberately not correcting those earlier returns, right, and then end up with a bigger penalty. So there is that risk. I should say, I did touch on it earlier on. We're doing an article on the WDF next week for Accounting Web, and there'll be one on the Let Property campaign, I think, for a different publication. So keep a lookout for that over the next few weeks. We've got we've got fresh data on the Let Property campaign. So I do like to get data on how many disclosures have been made, how much tax, how much interest, how much penalties have been collected by HMRC. We've got up-to-date records on this now for WDF and LPC. But interestingly, for the first time, we've got Let Property compliance data from HMRC, which we've never had before because they wouldn't give it, which is, you'd be shocked, I think, when you look at this. Early indications are that HMRC are doing more inquiries into landlords, for example. And so the yield on that, tax, interest and penalties, is actually quite a lot more than what they've got from Let Property campaigns. So look out for that, you'll get an idea. And the penalties are higher because the landlord has caused HMRC to get out of bed. So they're all going to be prompted. The penalties are higher, and they're probably going to go back further than they might in a Let Property campaign. Got another one, Moit. If someone doesn't report for 20 years their rental income, they want to come clean now, how many years would you report? Again, this is Moit, this is a question to be dealt with offline, because it all comes down to why, right? So if somebody is not doing tax returns, for example, under failure to notify rules, HMRC can go back 20 years anyway, right? Even if it's a non-deliberate reason. I mean, there are ways to cap it at around 2010, 2011, but this is a conversation for after this webinar, really. But where people are doing tax returns, the starting position is, do we stop them at 4 years? Do we stop them at 6? But if there's evidence or reason why HMRC would be successful in demonstrating that someone has deliberately withheld this information or deliberately caused their returns not to include it, then you'd have to go back, much longer. Perhaps not 20 years, but you'd have to go much further. It's a conversation for after this call, I believe. Ishan, how are we doing? We're about 1.5 hours in. No, we're not. We're an hour and 10 minutes in. I'm conscious that we've still got about 100 people online. So if you've got a couple of questions, we'll leave it open for a few more minutes. But I'm not seeing any questions. I'm going to wait 30 seconds. Let's see if there's any more questions coming in. Otherwise, I will bid everybody a farewell and a thank you again for joining. It means a lot for people sparing their time during the day. And I hope it's been useful. Ishan, are there any more questions?
Someone has their hand raised.
I've got a hand raised, Emmanuel. I won't say what your surname is, just so that it's clear, but I'm not sure how I can pick that up as a question. And your question's not in the Q&A box. I mean, if you do have a question, by all means, put it in the Q&A box, or perhaps get in touch with us offline. But I think on that basis, there aren't any questions. I am going to call it a day. Thank you very much to everybody for joining. I hope the slides deck next week and possibly this video is of use to you guys, and I hope that you stay in touch. Thank you very much for your time. Much appreciated.